Hi, Mark Rogers here. And over the years, I've worked with couples and they've gotten into their 60s and they're going, I want to retire. And I said, how you been doing? And they says, well, we've been doing well. We've amassed a 401k, or maybe it's converted to an IRA and it's worth 500,000, 800,000, a million or million point five. They've, over the course of years, deferred all of those taxes into an account called a 401k, 403b, 457, or it could be an IRA. And in doing so, there is a future day where the IRS says, give me the money, and that is coming up on them. And so what happens is that when they turn, now it's 72, the rules just keep changing, but it's advantageous to push it out. 72, they take now what we call RMDs, required minimum distributions. As I joke with my clients, it's like you got to understand the partnership you have with the IRS. Well, given that, if you are in a situation whereby you do not need to take the R&Ds, you don't need to live on those required minimum distributions, there are other ways you can benefit your family, and it's looking down the road a little bit because, again, the rules have changed from the IRS with regards to the Secure Act. Now it's 2.0, and this is going to impact your beneficiaries of that money. And so with that, I'd like to share with you a little something here that may be helpful to build growth on a guaranteed level if you don't need to use those RMDs. So here we go.
Do you have a tax-deferred retirement account like an IRA, SEP, 401k, 403b, or 457 plan? Did you know that you are required to begin taking taxable distributions from these accounts each and every year after you reach age 73, even if you don't need the money and you intend to leave it all to your family? The IRS calls these withdrawals required minimum distributions, or RMDs, and they are entirely taxable as ordinary income, not as capital gains. So the tax we pay on our tax-deferred retirement accounts could easily exceed 30%. What's more, there is an additional 25% tax penalty for not taking our RMDs each year. Now, these RMDs average between 3% and 6% annually and must be calculated on the total account value. But if our account value is growing at a rate higher than 3 to 6%, we will most likely have a very large account balance at the end of our life, despite the mandatory annual withdrawals. And our heirs will need to pay 100% of the remaining tax liability over the next 10 years. Remember that these are only tax-deferred accounts, and the government will collect tax on every dollar we've accumulated, even after we've passed on, which means that the money we've carefully saved and grown over many years in these tax-deferred accounts will eventually be depleted by as much as 30 to 40% in tax payments. However, if you do not want or need to take these mandatory distributions, there is a way under Internal Revenue Code Section 101 to pass the entire value of your retirement accounts onto your children or grandchildren tax-free, or continue to grow that money in your estate tax-free without any limitations or future taxation on the growth of your money. It's known as an RMD conversion. Here's how it works. In order to comply with the IRS requirements for minimum distributions, you first convert the money in your tax-deferred retirement accounts into a contractually guaranteed, mathematically calculated annual payout of both principal and interest over the remainder of your life. This is known as a lifetime income annuity, and it permanently resolves the need for required minimum distributions without the risk of penalties. The tax on these withdrawals is then withheld each year from these annual payouts, which leaves the remaining 60 to 70% in after-tax dollars. These after-tax dollars are then transferred into a tax-exempt life insurance contract that contractually guarantees to pay your family a tax-free cash benefit equal to the total pre-tax value of your original retirement accounts. In this way, you can recapture the taxes paid on the RMDs and replace the entire value of your pre-tax retirement accounts with tax-free cash and keep this money growing tax-deferred for generations. What's more, these tax-free cash proceeds can be A, reinvested any way you want and for as long as you want, B, distributed to your heirs in a single tax-free bequest, or C, paid out to individual heirs in annual installments for the rest of their lives. And you can do all this without any risk of losing the money and without any investment fees or advisory expenses. So you can either pay the taxes on the RMDs beginning at age 73 and ultimately deplete the value of your retirement accounts by as much as 40% in deferred tax payments, or you can do an RMD conversion to recapture the taxes paid as well as the after-tax account value with an unencumbered tax-free cash benefit. Interested? Then talk with the financial
Well, isn't it interesting that you have this scenario now built up if you've done all this good saving for all these years into a tax deferred account? Know the rules and know to find out can you maximize the value to your family. All right. And so there are some movements that have to be done. I'm recording this in 2024. There's still 2 more years of a particular tax provision going on that allows for even greater movement of money. But in the meantime, I'm certainly available to answer questions, and I work with professionals to accommodate this, to really maximize the value for each and every family. No matter what the circumstance is, we try to do our best to make sure that we're making your money grow safe and steady, and you're in control of it along the way. So with that, we'll look forward to seeing you on another one, and we'll talk to you